Good afternoon and welcome to another edition of Facebook Live. Today we're going to talk about understanding risk and return, and is there really any upside potential left in this stock market that's worth the downside risk? I mean, do you remember how you felt on March 9th, 2009? You may not remember that specific date, but you probably won't forget the pit in your stomach that day. It was the bottom of the financial crisis when the Dow hit a 12-year low of 6,547 points. Trillions of dollars in wealth had completely evaporated, and it was kind of a punch in the gut for everybody who was in the stock market. Many people believed the market would go up forever, but greed got the best of them. Even the people who were passively invested in their retirement accounts got hammered. Well, flash forward to today, the Dow has broken record after record after record over the past 8.5 years. Second longest bull market in history, but many investors are nervous that the party is going to finally come to an end. This conversation isn't about trying to time the stock market or suggesting that you should pull out of stocks, but it's time to pause and consider. You're nearly 10 years older since the last stock market correction. That means you're 10 years closer to retirement. Is any remaining upside in the market worth the downside risk? Are you needlessly taking on more risk than you need to at this stage of the game? That's really what it's all about. You know, and you've probably heard the expression, no pain, no gain. I hear it, you work out in the gym, you hear that. How many times have you heard that cliche to describe something you really didn't want to do? Unfortunately, investing carries a certain amount of risk, and with that risk can come some pain, but also could provide some gain. You have to weigh the potential reward against the risk of an investment to decide if the pain is worth the potential gain. Understanding the relationship between risk and reward is a key piece in building your investment puzzle. All investments carry some degree of risk. The rule of thumb is the higher the risk, the higher the potential return. But you need to consider an addition to the rule so that it states the relationship more clearly. The higher the risk, the higher the potential return, and the less likely you will achieve the higher return. To understand this relationship completely, you have to know where your comfort level is and be able to correctly gauge the relative risk of any particular stock or any other investment. Most people think of investment risk in one way: how likely am I to lose money? But that only describes part of the picture. You should consider that risk and others when evaluating an investment. Are my investments going to lose money? Is safety of principal more important to you than growth at this stage? Will you achieve your investment goal, or will your retirement be underfunded? The most common type of risk is the danger that your investment will lose money. Well, you can make investments that guarantee you won't lose money, but you give up the investment rate of return. For example, Treasury bonds carry the full faith and credit of the United States. They're the safest investments in the world, but you're not going to earn a whole lot. So the elements that determine whether you achieve your investment goals are the amount of money you invest, the length of time invested, the rate of return or growth, and then you have to factor in the fees, the taxes, inflation, and so forth. If you can't stomach much risk in your investments, you will earn a lower return. To compensate for the lower return, you must increase the amount invested and the length of time investing. And then in the tail end of the show yesterday, I talked about how emotions drive your financial decisions, and it's kind of interesting going through this. Anxiety was one emotion that perhaps triggers your financial decisions. It says if you're still gun shy about the market from 2008, 2009, you may have been sitting on the sidelines for a long time. And if you're concerned about losing money if the market crashes, you really need to talk to a planner about whether the pros of taking a more aggressive position outweigh the potential risk. You got to have a plan of action. Sabotaging emotion number 2 is jealousy, and we see this quite a bit. I call it keeping up with the Joneses. You know, if your neighbors just put a pool in, if your neighbors just got a new car, you may be tempted to run out and try to duplicate that and spend money which maybe you don't have. So again, you reframe this. You turn your jealousy into a growth opportunity by doing a self-examination about your finances. What is missing in your life that you don't have? And another simple strategy, which I brought up on the show, is start a gratitude journal. Jealousy makes us feel insecure and inadequate. Focus on what you've got going for you rather than what you're lacking. Regret could be another emotion that helps you make lousy money decisions. procrastinating about signing up for a 401k or investing in real estate. If you have regrets over moves you didn't make, you wouldn't be alone. 10% of Americans said their biggest regret is finance related. So again, learn from your mistakes. Remorse helps people make sense of the world and avoid future behaviors with negative consequences. Emotion number 4 may be embarrassment. If you're embarrassed about, what your budget looks like, what you spent on a certain asset. Again, you shouldn't let that drag you down. When you're with someone, again, here's another example. You're out to dinner and you order the cheapest entree on the menu because you're trying to save money for something else. When the check comes, you're a little embarrassed. Well, when you're with someone you know well, it pays to be honest up front. If you're catching up with an old friend over dinner, tell them up front, hey, I'm looking to save some money, would prefer separate checks. A good friend will understand where you're coming from and encourage you not to overspend. So, again, I'm not sure there's a whole lot of upside left in this market that's worth the potential risk. If you're near retirement, you better take steps to protect your nest egg. This has been another edition of Facebook Live.